recovered last week. Earnings season kicked off on a quiet note, and one major company had a really bad week. My name's Daniel, and I'm going to get into those things today on the long and the short of the markets. Subscribe to this channel on YouTube. Check out shortinvestingguide.com for more of my investing guide content. Check out middlecoastinvesting.com for text versions of these videos. Markets recovered, more or less rebounding from the first week of the year. We're back where we started the year, give or take 0.5% on all of the indices. Nothing major going on yet. Inflation data was mixed. Consumer price index a little bit higher than expected. Producer price index coming in better, lower inflation. Seeing a trade-off, nothing really changing the direction of the market, the expectations for the Fed as far as rate hikes or rate cuts. No major movements there. Earnings season kicked off on Thursday and Friday. Again, not huge events. Delta Airlines reported earnings. It's not yet expecting to reach its target earnings this year, which was disappointing to investors. There's always the risk of a recession crimping Delta's recovery and all of the airlines' recovery. So you saw a sell-off there. Nothing huge there. Banks, pressure on net interest margin is expected as the Fed starts to cut rates. It's a little bit contradictory as many banks were suffering in the sharp rise in interest rates. We'll see how that plays out. But again, no major stunning things. Earnings season is always the meat of the year or the meat of each quarter, and I really look forward to it. I don't know that I'll have a lot of wide angle takes on earnings, but I'm sure there'll be interesting stories that come out of it over this next few weeks as we get the biggest companies and then other companies report earnings. But there were a few big stories last week that I thought were interesting, not in quite the same way as the previous video where we talked about read-through effects, but instead in terms of why you don't necessarily need to have a take on some of the biggest stories in the market. To do that, we're going to talk about in its way, fallen angel, and then we'll talk about a couple other smaller stories that explain why you don't necessarily have to have a strong opinion, but you can still learn from these sorts of stories. Let's start with Boeing. Boeing had a bad week last week. The airplane manufacturer saw its shares drop 12.5% after news broke of prior weekend, a door plug falling out of a plane mid-flight, an Alaska Airlines plane that was flying from Portland. Fortunately, as you probably know, the plane turned around, nobody got injured, iPhones even survived the fall. So all in all, not a tragic story, but not a great one for Boeing shareholders or for the company itself. This happened on a MAX 737 MAX 9 plane, and it is the latest in a series of incidents with the MAX planes that Boeing has faced. Most notably, MAX 737 crashes in 2018 and again in early 2019. Boeing shares have struggled over that period. It's down 36.5% over the past 5 years, up only 1.6% in the last year, and really the only good time frame you can find for Boeing, as we'll discuss, is from the bottom of the COVID scare in March 2020, March 20th, 2020 to now. Boeing is up about 130%, which is ahead of the S&P 500. I don't own Boeing shares and never have. I know professional friends who have traded Boeing shares regularly. I know non-professional friends who have had Boeing in the portfolios that they run or that their investment advisors run or what have you. Boeing is a captain of industry. It's a stock that I studied most closely after the MAX crash when we did a 3-part podcast series at my old job, Seeking Alpha, with a colleague. We talked to a airline pilot who could give us a take on the airplane. We also talked to an airline industry expert. It was really interesting to go into it, but I've never really developed a specific expertise with Boeing. I think Boeing's interesting, though, because it's often used as a stand-in for travel. Boeing is a symbol of travel's recovery, along with, I would argue, Delta and Carnival as representatives of the airline industry and the cruise line industry. Those are some of the most obvious ways to consider travel and to consider playing the market. But my argument today is that Boeing is also one of those 50, 75, however wide you want to think about it, one of the biggest stocks in the world and one of the ones that people default to when they think of what they can invest in. And my argument is that there are a lot more stocks out there, and you don't have to default to Boeing. Let's start with a basic forward-looking case for why you might consider Boeing shares. First of all, Boeing is a captain of industry. It is one of the two airplane manufacturers that you will know or consider when you're usually flying in a commercial airline. Airbus, which is based in France, is the other one. You're basically going to be in one of their airplanes whenever you're flying. There's exceptions, but that's the general rule. They're giants. They have a huge advantageous position. It's unlikely that new companies are going to threaten it. China is trying to develop a commercial airplane industry. I'm not up on the latest information about this, but from what I have heard, it's still a long way away from being a threat. Boeing has a strong industry position, and you can make a case that their shares should be attractive. The company is hoping to make $10 billion in free cash flow by 2025 or 2026. They're not precise on that. But we can say that they have made more than that in the past, in 2017 and 2018. So it's not an unrealistic target. And if they get there, and you say that those free cash flow dollars are worth 20 times as a multiple for the shares, that gets you to something like $270, $280 a share, which is about 25% higher than where shares are trading after last week's sell-off. 25%, I would argue, is not high enough, but you could say that the multiple should be higher. You could say that Boeing is going to grow more over time, whatever. That's your case for why Boeing shares are interesting. We can also look at Boeing's performance. Since the COVID bottom on March 20th, 2020, Boeing shares have recovered 129%. That is higher than the S&P 500. It's higher than Delta Airlines, which is 82% if I have it right. Carnival Cruise Lines, 41%. And basically most of the airline industry and cruise line industry. The exception there is Royal Caribbean, which is up 410%. Don't really know what happened there. Airbus is at 156%, which is better than Boeing, but that's basically down to the last week. Boeing was ahead of Airbus before last week's crash, so wouldn't even take that too seriously. But there are a couple things there. First of all, COVID bottom is a very favorable time frame for Boeing. It's a logical time frame in one sense, because that is a time when we were looking at what was going to happen to travel. And so it's a very clean break, but we didn't know when the bottom was going to hit. Even if you knew that after Congress passed the America's Care Recovery Act, or whichever act it was to invest in the economy, even if you knew from that point, that's still a tough play. I did not do a lot of great investing then. I was still pretty cautious about investing, so I don't claim to have bought at the bottom. But also, Boeing shares basically took off from that bottom at March 20th, did really well for a year, and then have kind of been flat since then. And because of the MAX problems, they were down before then. Boeing shares are down 36.5% over the last 5 years, and over the last year, they're only up 1.6%. For the last 3 years, 4.4%. So all of these time frames you can kind of play around. It's a big part of the subjectivity in tracking the market. But we can say that this was a very favorable one for Boeing. The other thing we can say is that if you look beyond these obvious names, airlines, airplanes, cruise lines, which again, I would argue that a lot of people default to when thinking about this. If you look beyond that, you'll find a lot of other industries in the same general sector of travel that did quite well and better than Boeing if you look across the industry. I'm not going to name all the names, but I'll mention industries and I'll flash on the screen so you can kind of see their performance compared to Boeing's 129%. You can think about aircraft lessors, companies that buy planes from Boeing and Airbus and then lease them out to airlines. They have done better. Airport operators, not super common in the US, but there are the Mexican airport companies. And then there are other companies abroad which actually have lagged Boeing, but the Mexican airport companies have outperformed comfortably. RV manufacturers have done much better than Boeing, which Again, the COVID dynamic for them was a little bit different than others, but still, they've done better. Online travel agencies have done better. Booking.com, Expedia, TravelZoo, though not all of them. And I can't include Airbnb because they didn't come public until later that year, and their results have been a little bit funkier. But these are different industries that are all within the broader theme of travel, that are less followed, less known about than Boeing, less in the headlines, and that have outperformed. None of this is to say that I was right because I own some of these companies. I got lucky. I didn't make any great buys at the bottom. Like I said, only a handful here and there. My broader point is just that it's okay to not stop at Boeing, but to think beyond that, to look to other industries. I follow travel closely. I am curious about the sector. I enjoy the sector. You don't have to follow every stock. You don't have to go through an entire industry to find the best. That's a very high bar. But I just encourage you to consider going beyond the most obvious, most immediate in the headlines play. Because often that headline take is hard to have and hard to differentiate from what other people think. It's hard to have a strong opinion when there's so many voices out there. Let's illustrate that with a couple more stories from last week. One of them was the approval of various Bitcoin ETFs. Long awaited, a lot of excitement. Bitcoin has had a big runoff since whenever its most recent bottom was. And I think this is a great story to epitomize this because whenever I tell somebody who's not in the finance world that I invest either on my own or as a professional, inevitably they ask me, what do you think about cryptocurrencies? What do you think about Bitcoin? Because they don't like to hear just the answer, I don't know, and because I worry that people will get FOMO when they see headlines about Bitcoin, I usually say something like, I don't see anything there. I don't really understand why anybody would own it, what the benefit is. And so I stay away from it. But that's not a very strongly held opinion. And yes, somebody who is a big Bitcoin fan and who hears me say that will say, yeah, but scoreboard, bro, look at how much Bitcoin has gone up. And it's the future. And they will have a story, and that's fine. I may or may not agree with it. In fact, I don't agree with it. But that's okay. I don't have to make money their way. They don't have to make money my way. And if they succeed, that's great. It's not really taking away from anything I'm doing. And what I'm doing isn't necessarily taking away from what they're doing. You don't have to have a take on cryptocurrencies. Another story last week. Microsoft passed Apple as the most valuable company in the world. Though I should say that my calculation from closing price, if I have the right price, I think Apple is still a touch ahead in both market cap and enterprise value from the close Friday. Nevertheless, that's a fun story to follow. And I worked in financial media. I don't want to say anything bad about financial media. I am not one of those, oh, here's the truth about financial media. But they're trying to get interest. They're trying to get readers. That's the nature of the game. And it's a fun story to follow. It's a fun thing to think about. But investing in stocks is not like following sports. You don't need to root for your stocks to be the best. You don't need to care who the champs are. There are no playoffs. There's nothing that you need to keep track of on that level. Is there anything that's changed between Microsoft and Apple in the last week? Not really, just some trading differences. Is there a reason to consider buying those stocks? Yeah, potentially, and that's what you should be focused on. I don't have a strong take on them. I own Apple and I own one other Magnificent Seven stock, but it wasn't my own buy. It's a client that I'm managing it for. But the thing about those stocks is we can definitely learn a lot from them. They all tend to be great businesses. A stock that grows that much, millions of people can't be wrong in thinking that there's something there. And they obviously make a ton of money. We can learn from them. They will often have read-through effects like I talked about last week. And there will be times where they offer great opportunities. Apple in the mid 2010s. Microsoft too, though Microsoft there was a more fundamental change happening. Meta, the parent of Facebook, in the end of 2022. There are great opportunities that are relatively attainable, and that's fine. You can wait for those. At the same time, as much as the story last year was about the Magnificent Seven and how that drove the market, there were plenty of other great performing stocks out there. And it's hard to find not only a unique angle, because you don't necessarily need a unique angle, but a unique understanding of why you'll own shares and how you'll behave differently from the rest of the market in those heavily covered names. It's less so for a case like Boeing, but still, when you're talking about the most popular stocks in the world, it's top 7 or the top 25, top 50, whatever it is that everybody seems to talk about, it'd be hard to have an angle. And sometimes it's okay to just say, I don't know, and to look for something where you have a little bit of a different take and understanding than a lot of people out there. One of the key secrets of investing is that a lot of times there's nothing to do, and a lot of times what there is to do won't matter for a long time. One of the things I tell my brother, who used to be my wrestling coach, is that you can't coach up your stocks. You can't yell at them. You can't give them an idea so that they'll perform better. You just have to wait and then seize opportunities when they come. In investing, there's a lot of work that can be done, but it'll be work that will have an effect on your portfolio in the months, the years, even the decades ahead. Famous value investor and fund manager at Baupost Group, Seth Klarman, wrote the fabled margin of safety. And in there, he wrote something to the tune of, in investing, a lot of times the right thing to do is to do nothing. Financial media doesn't work that way. The finance industry doesn't work that way. Both industries are trying to get your attention, not out of any malevolence necessarily, but because their incentives are for you to be reading, to be acting, to be trading, to be changing. Activity is what makes those industries run. And there's nothing necessarily wrong with that. It just isn't what you need to care about. With these headline stories, I think it's always worth reading. You never know when your next idea is going to come about. You never know when you can get a better understanding of a stock you own, whether it's directly or through inference or through analogy, whatever. So it's always worth following. I think it's healthy if you have the time to track the market. But when a door plug falls out of the sky and it affects a stock, you don't necessarily have to have a take about it. Whatever your angle, whatever your bias, whatever else, you don't have to have an opinion. You can just read about it and then go on looking for stocks that'll be good opportunities for your portfolio. That's the long and short of the markets for this week. Again, my name is Daniel. You can subscribe to this channel on YouTube. You can check out the text version of this on middlecoastinvesting.com. Check out new episodes of A Short Investing Guide coming out this week and next. And we'll finally have those going out. Thank you for watching, and best of luck to you in the week, month, year ahead.